Hello, and welcome to Portfolio Matters Weekly Markets Checklist, week 194. But before I get into it, I will read the disclaimer. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we'll be discussing securities that we own or have financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Full disclaimer can be found at the end. Before we get going, some housekeeping. I'm afraid this week Richard is away on holiday and Stuart Owen is stuck in traffic but will be joining us in a bit. And I'm afraid in the coming weeks the schedule will be disrupted due to holidays. Again, my apologies. But first of all, the news. So it's never a dull week with Donald Trump in the White House, and he has upped the pressure on the Fed by attempting to dismiss the governor, Lisa Cook, for mortgage fraud. Apparently, she declared two separate residences as her primary residence when applying for mortgages, and according to the latest reports, there may even be a third. However, she has disputed his power to fire her and countersued. She remains in office presently. It's likely that the Supreme Court will have to decide whether Trump has the power to dismiss her. If he does dismiss her and replace her with one of his own appointees, his faction will have a majority on the Fed board and are likely to support easier monetary policy. In France, the Prime Minister, Francois Bayrou, has called a confidence vote for the 8th of September over his demand for 44 billion euros of budget cuts. The markets fell heavily on the news, particularly the French equity index, the CAC. He's expected to lose. More political turmoil in France is likely. French unions are expected to call for strikes on the 18th of September to protest against the government's plans for fiscal consolidation. We have a few charts coming up. In his Jackson Hole speech, Jerome Powell stated that the downside risks to the economy in the US were rising, and the Fed is now expected to cut rates in September. 50% tariffs on Indian exports came into effect. Also, the US Court of Appeals has ruled that most of Donald Trump's tariffs are illegal, and that the president lacked the authority to impose tariffs. But it allowed them to remain in place until mid-October. The Supreme Court is again likely to decide. The only really important economic news over the past couple of weeks was UK inflation, and it was bad. So UK inflation came in hot in July at 3.8% year on year, core 3.8% as well. Both were up on June. In market news, tech stocks fell after MIT reported in a study that only 5% of corporate AI projects succeeded. 95% of projects failed, returning zero on investment, leading to concerns in the market that AI was overhyped. The global bond bear market continues. Long bond yields continue to climb, particularly in the UK. Sadly, gold has resumed its climb, helped by Donald Trump attempting to undermine the independence of the US Federal Reserve. Some charts relating to the news. So this is the probability of a rate cut in the US. So the market is now expecting January 2027 US interest rates to be below 3%. And for the Fed funds rate at September meeting to be between 4 and 4.25%, i.e. a 25 basis point cut. Now, one of Donald Trump's explicit aims in attempting to get the Fed to cut interest rates is to lower mortgage rates and boost the housing market. But Most US mortgages are 30 years and they are referenced against the 30-year yield. And you can see that as the Fed funds rate has come down, 30-year mortgage rates have not come down. And if Donald Trump undermines confidence in the Federal Reserve's mandate to fight inflation, the market will start to fear that inflation will stay higher for longer in the US. Long bond rates will stay high, mortgage rates will stay high. So it's not a very good strategy for boosting the housing market. So this is the composition of the Fed Board of Governors, and Lisa Cook has the longest term before her term expires. It expires in 2038. And you'll see that there are now 3 Trump appointees on the board. If he were to replace Lisa Cook, he would have 4. So he would have a majority. So bear in mind that most Trump appointees essentially prove to be his lapdogs. It's likely that his Fed governors will be the same and will tend to cut interest rates more than they otherwise would, which will be good for short-term yields, probably bad for long-term yields. But the market thinks that the president doesn't have the immediate authority to fire Cook and is placing a 75% chance on her still being there at year end. The Supreme Court will have to decide. Turning to France, well, this is the popularity of France's prime ministers, and Francois Bayrou is what, 12%, not popular. He looks doomed. Now, the problem for Bayrou was he was attempting to be sensible and prudent. So this is France's current fiscal situation. It has debt to GDP of approaching 120% and a fiscal deficit approaching 6%. It is down the bottom of this chart. Its debt dynamics do not look very good. If its bond yields are rising, it could be heading for a sovereign debt crisis or a bailout from the IMF. Maybe it requires a crisis to provoke change. So France's debts are higher than the EU average and rising faster. Now, the Eurozone could bail out Greece because it was a relatively small country. The total debt involved was 320 billion. The bailout was 100 billion. France's national debt is 3.3 trillion euros. The Eurozone does not have enough money to bail out France. And if you look at what the net debt issuance in France has been spent on since 2017, 44% of it has been spent on pensions. So France has unsustainable welfare spending, particularly on pensions, and a populace that is unwilling to contemplate change. The market is concerned. French bond yields are rising quickly, and then charging an increasing premium for buying French debt over German debt. Now 80 basis points per annum. If you look at the chart left, which shows the changes in government deficit and debt over the period 2019 to 2025, you'll see that although the French fiscal deficit has deteriorated, Austria, Slovakia, and Germany are actually worse. And in terms of its debt levels, it is the worst. So France's debt to GDP has expanded the most of any Eurozone country over the period. Finally, MIT reported that only 5% of US corporate AI projects were successful. So general purpose large language models, actually 40%, but task-specific AI, only 5%. Now, when we talk about political pressure on the Fed, there was an interesting paper out this week by Thomas Drexel of the University of Maryland that looked at the effect of political pressure on the Fed over the period 1933 to 2016, and it concluded that political pressure to ease monetary policy tended to produce strong and persistent inflation, but have no real effect on the real economy. It didn't boost economic growth. And this is the key set of charts. So bottom left shows latent political pressure and over time, and the middle chart shows the shock resulting from political pressure on the T-bill rate, i.e. short-term interest rate. And so you can see political pressure causes a decrease in interest rates, but the final chart at the bottom is the GDP deflator, i.e. inflation. And so you see that it causes a pickup in inflation. So political pressure on the Fed leads to low interest rates, higher inflation. And it also leads to higher inflation expectations, which is the blue line. Although you'll note it takes a couple of years for that to start coming through. Bottom line, history suggests that political pressure on the Fed to lower interest rates does lead to lower short-term interest rates, but it also leads to higher inflation. So if Trump were to succeed in replacing Lisa Cook and his governors were to lower interest rates more than they should, that would be bad for inflation, bad for long bond yields in the US. And while we're at it, let's talk about Lisa D. Cook, the Fed governor that he's attempting to replace. This is her. So she was the professor of economics at Harvard University and Michigan State University. Prior to that, she was on the Obama administration's Council of Economic Advisors before joining the Board of Governors of the Fed in 2022. But her publication is thin for a tenured professor and largely focuses on race activism rather than quantitative economics. Her most cited paper is Violence and Economic Activity, Evidence from African American Patents 1870 to 1940, in which she examined the number of patents by black inventors, concluding that the number plummeted in 1900 because of lynchings and discrimination. This is the data from her paper. You can see in 1900, the number of black patents collapses, the number of white patents don't. So she concluded that that was because of racial discrimination and segregation laws, leading to lower confidence and fewer black patents. But the Brookings Institute later examined the same issue, and they found no fall in black patents, which was the red line. They continued to rise over the period, as did the total number of patents. And it seems that the core problem with Cook's data was sheared use as one of her major data sources, the World Fair of 1900. And the World Fair of 1900 ends in 1900. So it stopped collecting data after that point. So the reason she got a huge drop in the data set in 1900 was that one of her sources stopped collecting data at that point. She was a diversity pick. She has no claim to be one of the top economists in the country. So when we talk about the Trump administration stuffing US institutions with its own ideological stooges, well, the Democrats were just as bad. And on that cheery note, on to equities. So it's been a pretty indifferent couple of weeks generally. The All World is up 0.2%, but up 13.6% on the year. All Share up 11.4%. Stocks Europe down by 0.5%, almost certainly France causing that. The S&P 500 up 0.2%, up 9.8% on the year. Russell 2000 has had a good couple of weeks, up 3.1%, still lagging the major indices, only up 6.1% over the course of the year. The Nasdaq's actually down a touch, but still up 11% on the year. Hang Seng is going great guns, 27.7% on the year. Topics down a bit, but up 10% on the year. Bitcoin had a bad week, down 5%, still up 18% on the year. Sterling and the euro continue to rise slightly because the dollar continues to fall as Donald Trump undermines its credibility as a safe haven. VIX rose a bit to mediocre levels. So this is the all-world index. Does that look like it's topping out? Bear in mind, we're about to enter September, October, traditionally times for market wobble. This is the all share, had a good run since April. The Euro stocks pretty flattish actually since the February. S&P 500 grinding higher. Nasdaq still a good looking chart. Russell 2000 actually now looking like a trend upwards. So Hang Seng looking very strong given that Trump has imposed tariffs. The Chinese economy is also not strong, as we've talked about many times. But the market doesn't appear to care. Topics up 10% on the year. Bitcoin still up 18% on the year, although it's had a bad week. Sterling up 8% on the year. Euro up 13% on the year. Dollar index going nowhere. VIX still very low. Markets complacent, I would say. So some charts relating to equities. Well, the S&P 500 is back to all-time highs, having risen 34% since the April lows. Really amazing. I thought this was interesting. When we talk about the bubbles, potential bubbles in AI, this is wind power, which went from 1 to over 6, so six-fold rise in 4 years, 5 years, and has now completely retraced that. Markets get carried away. Nvidia reported during the week, and they marginally beat forecasts, although the forecasts were still very strong. So Nvidia's market cap now exceeds that of the whole of the FTSE, the whole of the CAC, the whole of the DAX, and the whole of the S&P energy sector. 90% of Nvidia's revenues are from data centers. That's the green bar. Its revenues were up 56% year on year. Earnings before interest and tax were up 53%. Earnings per share were up 61%. Amazing performance. This is the earnings per share of the Mag 7 in blue. So since ChatGPT has been instigated, their earnings have absolutely gone through the roof. But when you look at the earnings per share of the other 493 companies in the US, they ain't going anywhere. So no wonder really that the tech stocks have been driving relentlessly higher. How much higher can this go? This is the percentage by which Nvidia has beaten earnings and revenue targets quarter on quarter over the past couple of years. And you can see the size of the earnings beat is trending lower. It's still beating, but by progressively less and less. And Nvidia's earnings have been driven by investment in data centers, and this is the free cash flow of some of the big data companies, the big tech companies, Oracle, Meta, Google, Amazon, and Microsoft. And you can see that their free cash flow has actually been declining despite excellent earnings, excellent and rising earnings, because they've been spending so much on data center investment. In fact, Meta last week issued 26 billion of debt and 3 billion of equity in order to fund further AI investment, particularly in data centers. So they're now investing so much, they're investing more than their cash flow, having to turn to the debt markets, and certainly Meta is. So this chart shows NVIDIA's expectations for investment in data centers by the big US tech companies, Alphabet, Amazon, Microsoft, and Meta. So over the 6-year period between 2025 and 2030, NVIDIA is forecasting 3 to 4 trillion in data center capex, which is over 10% of US GDP. That is a lot. And we talked previously about Palantir. Its shares have quadrupled over the past year. It trades on a forecast 2026 revenue multiple of 67. Now, to put that in perspective, so this is its valuation compared to other companies in the sector. Forward PE ratio is over 225. Forward sales ratio is just, this is a massive outlier. Its valuation is extreme. According to Charlie Bilello, its forward PE ratio is 217. So the rise in the share price is driven by multiple expansion, not by earnings. Punters keep on adding to debt. So FINRA margin debt has hit a new all-time high. Tech stocks are almost 35% of the S&P 500, and US valuations are much higher than in the rest of the world. Other signs of exuberance. Do you remember Fartcoin, which we covered last year? Well, it's still around, believe it or not, and it's got a market cap of 740 million, which is still big. But maybe markets are some way efficient, because this is the Melania meme coin, launched when Donald Trump became president, and is now down. Only 98%, but it's still worth 167 million market cap. I think it's going lower. And on to commodities. So everything was strong. It's been a strong couple of weeks for commodities. So Brent bounced by 2.7%, still down 9% on the year. WTI up 2.4%, still down 10% on the year. Natural gas futures, sadly, in Europe were strong. They're down 35% on the year. Very seasonal. So obviously summer prices are going to be lower than winter prices. UK nat gas prices rose 7%. US natural gas prices rose 2%. Coal, having rallied, faded again. Uranium, is the bull market back on? So this is Brent, bounced a bit from its recent lows, but still well down on the year. And reminder, OPEC Plus are opening the taps, and the EIA is forecasting that US oil prices will go into the 50s and have a 5 handle by mid next year. This is WTI 65. Numbers specific to the oil market. Well, actually, there was an inventory draw over the last couple of weeks. So the US oil market was undersupplied. But although the Baker Hughes rig count is down 70 on the year, US oil production climbed back up by 112,000 barrels a day over the past 2 weeks, taking it back towards its highs. So despite the rig count falling for quite a long time now, the US oil production remains very high, which suggests that once again, productivity in the shale patch continues to improve, and the shale drillers are getting more for less. So they're putting fewer rigs to work, but the wells they are drilling are more and more efficient. So this is the 12-week average of US oil production, and it's back towards its highs. EU natural gas futures up over the past couple of weeks, but towards their lows. And I thought this was interesting. Remember at the start of the Ukraine war that the Nord Stream gas pipeline was blown up and nobody claimed responsibility. Well, I thought it was unlikely the Russians would have done that because they export gas through that pipeline and hence they make money from it. Likewise, the EU, why would they blow it up? They need the gas. The people most likely to have blown it up were the Ukrainians, and they've now arrested a Ukrainian in Italy who's accused of essentially chartering a boat and then diving down to the pipeline and blowing it up with explosives. The UK natural gas futures towards their lows, although point to point up over the past couple of weeks. This is US natural gas futures, again up over the past couple of weeks, but towards lows. Coal down from recent highs, but found a bottom. Uranium, the bull market looks to be back on, up 5% on the year. Onto industrial metals, again, generally strong. So aluminium up 1.2%, copper up 1.3%. Lithium, which has had a very good run recently, actually fell, but neodymium kept on rising, now up 58% on the year, or that is it, though that price is in China. Nickel, tin, and zinc all very strong. Tin up 20% on the year. So this is aluminium. Not doing much, to be honest. Cobalt going nowhere. Copper well down to its highs earlier in the year. This is the price on COMEX. Was caused by Donald Trump threatening tariffs on copper, but he's since clarified that to exclude copper ore and semi-finished goods. Iron ore going nowhere. Lithium coming down to earth a bit, having had an extraordinary run over the past couple of months. Neodymium still rising. And I thought this is a great chart. This is production of rare earth oxides in thousands of tons, and it shows how China has ramped up production over the past few years. So it is odd that the price in China has had such a strong run. It implies the price spike is not to do with supply and demand, unless demand growth has outstripped supply growth, which seems unlikely. Something else is going on. This is nickel, stable. Tin, that still looks like a rising chart. Bull market in tin. Zinc going nowhere. Precious metals, well, gold broke out to new highs. Great week, up 4%. Silver up 7%, up 40% on the year. Platinum up 60% on the year. Rhodium up 54% on the year. This is gold breaking out to new highs, just as Richard Wheater predicted. Silver also breaking out to new highs. Platinum going back towards new highs. Rhodium peaking. Palladium picking up again. And on to rates. And hello to Stuart Owen, who has
Hey Keith, how you doing?
escaped from the traffic. I will just do rates and then we'll move on. Stuart will start pitching in. So on to rates, and it's been another terrible couple of weeks with the UK yield curve shifting up yet again. There's been a huge rise in UK bond yields over the course of the last year following Labour's disastrous budget, which tended to increase UK inflation and increase the deficit much more than the market could tolerate. The US yield curve also has shifted up over the past couple of weeks. The problem in the US is short-term inflation expectations are rising. The blue line is the 1 year, 3.5%. The 2 year is at 3%. These are extraordinary numbers. These are not converging on 2%. And given, actually, Stuart, I'm finding this struggling to believe this, actually, because we know that US CPI is 2.8%, 2.7%.
I mean, the immediate thing I grasp for is tariffs and short-term impact, and people don't know how how much there'll be second round effects. But if this is a technical measure from the tips markets,
Yeah.
then perhaps people are calculating what they think the impact is going to be from tariffs just over the first couple of years.
Yeah. Okay. That seems extraordinarily high to me. Anyway, we will return to this in a second. So the blue line is the expected Fed funds rate in December 2026. So next year, you'll see that's been coming down over the course of the year and is now expected about 3%. But the 30-year has been rising. The market is increasingly demanding a credit spread to buy long-dated US government paper. And if we return to this chart, see over the course of the year, inflation expectations have been pretty stable. So that represents credit risk of lending to the US government. Goldman Sachs is forecasting that UK inflation will fall later in the year and will hit the Bank of England's 2% target by 2027. Now, that is very much what the Bank of England believes. And they think the Bank of England will be able to cut interest rates to 3% by mid next year. This very simple chart. So what this chart shows is the blue line, every month you add 1% annualized inflation. The red line is 2%, the grey line 3%, the green line, what's that? 4.8%. And this shows what would happen to UK inflation using a simple dropout model, i.e. every month you add, in the case of the orange line, 1 month's worth of 1% annualized inflation, and you take off the data point 12 months ago. So you can see that if inflation were to remain to be somewhere between 2 and 3%, UK inflation would peak in September and then start to come down towards target, but you wouldn't really see any progress until April next year, in 6 months' time. And they're expecting UK inflation to come in between the medium, which is the red, and the high forecasts. So they are expecting UK inflation to come back towards the 2% target simply from a dropout model by mid next year.
Well, the key thing with which I think you've raised in previous shows is how can this really happen if wages are growing at 5% a year? I'd be interesting to know what assumption they were making about wage growth.
Well, that's the thing, Stuart. I mean, the reason the Bank of England have cut rates as they've done is they're saying a weakening labour market will feed through to lower wage growth and lower inflation. But so far, what we've seen is when you look at the Indeed job vacancy numbers, UK jobs market has done worse than any other G7 country, but its wage growth is much higher. And last week we were talking about how the July numbers showed that UK posted adverts for UK job openings showed wage growth of 5.9% year on year, actually rising despite a weakening labour market. So the Bank of England's assumptions look pretty flaky at the moment.
I think this chart really, everyone needs to be aware of this. It's just extraordinary to me that credit spreads are so amazingly tight.
Yeah,
There's no cyclicality built in, and I couldn't touch any sort of credit fixed income at the moment. You're just not being paid for anything.
absolutely. So moving on to the chart. So this is the UK 2-year. So we saw earlier that Goldman are forecasting that the UK, that the Bank of England should be able to cut interest rates to 3% by mid to late next year. Well, the 2-year is not discounting that at all. It is saying that UK interest rates will stay on average of around 4% over the next 2 years. Seems extraordinary to me, but so far UK inflation has proved persistent. The 10-year moving back to its highs, 30-year at new highs. Terrible. 5.64%. So the trouble is, if you are attempting to do any long-term investment in the UK, money is getting more expensive. This is the US 10-year. In contrast to the UK, that looks to be stable to coming down a bit. So markets worried about UK inflation in particular. German 10-year rising as it borrows more. That is indigestion in the market. France looking uncomfortable, rising quite quickly. France has an unsustainable fiscal situation. This is Italy, now lower yields than France. Greece going nowhere. Japan, 30-year. That's not looking very good. And on to this week's economic data. So a quick summary before I hand over to Stuart. UK, stagflation. Inflation is rising. The economy is going nowhere. EU stagnation, low inflation, economy not doing much either. The US actually, the labour market looks like it's slowing. We'll get more information on Friday when we get non-farm payrolls for August, but the economy itself ticking along. China, again, no inflation, economy doing okay. According to the Chinese statistics, it's growing at 5%. We don't believe that, but it is still growing. Right, on to the UK, Stuart.
Right, first up, CPI. So month on month, the expectations were for a slight fall. There was a slight rise. So year on year, we're now at 3.8%, and the trend does not look at all encouraging.
No. So the Bank of England was forecasting it would peak in September, which these other charts corroborate. So that means we've got rising inflation in the UK for the next couple of months, likely to breach 4%, in my opinion. Not good.
Core CPI, well, it's a very similar story, really. Again, 3.8% year on year.
Yeah. But to be fair, not rising as much. The thing is, this dip in UK inflation was all due to falling energy prices. And now that's coming off. Is
Well, but I would emphasize the word core here. When you're
yeah,
right, it hasn't bounced back so much, but you're stuck between 3 and 4.
yeah,
It's too high. I
it
suppose
is
it's
too high.
quite good
Yeah,
for Rachel Reeves and general wage inflation, and she can take more of a tax take because people's wages get sort of inflated up into higher bands, and she keeps the personal allowance, etc., frozen.
that's true. But also, 1/3 of UK debt is index linked, so she can't. It's difficult for the UK to inflate away its debts. And also, we've got the ridiculous triple lock. So the more volatile UK economic data is, the more the pension bills rise.
Good point. I hadn't appreciated that the linkers were 30% of our debt. That's chunky.
Yep.
Well, talking of which, linkers are linked to RPI. So RPI year on year, 4.8% now against expectations of 4.5%.
Yeah. Huge. That is a big number.
UK is a clear international outlier. When we look at the inflation rates here, most other countries, they're both lower and trending in the right direction. This is not good. The inflation miss was primarily due to higher food prices and to airfares. If you take them out, yeah,
Yeah.
it's marginally less. Yeah.
Well, the thing is, airfares are volatile. So, hopefully it should come down a bit after the summer travel season, but we'll see.
Services inflation is back to 5% year on year. Well, I suppose there we go. There's a link to wage inflation, isn't there?
Yeah,
Uh,
terrible.
not coming towards 5% at all. So I know it's a bit gloomy each week, but the stats are gloomy.
Yeah, we are stuck in stagnation. And I really thought monetary policy worked. And we would, moving from essentially 0% interest rates to 5.25% interest rates at their peak would rapidly slow the UK economy and bring the inflation under control. And I've been absolutely wrong. I mean, lessons for life.
Airfares were responsible for much of the miss, but hotel and restaurant prices were also notable and not good.
Yeah, that's terrible. That's services inflation just not coming down.
Yeah. Manufacturing PMIs hadn't reached back to 50 at 47.3, lower than expectations, 48.3, so grim. So turning to services PMI, though, that's actually a rather encouraging news there, up to 53.6. Now, what does this text say?
Yeah, looking forward, firms' expectations for business activity improved, underpinned by investment plans, product diversification initiatives, and a projected rebound in domestic consumer demand. So
Well,
everyone's just feeling more positive, essentially.
fingers crossed. Yeah. So the composite, reflecting that weight towards services, hit 53. Not bad.
Yeah.
Consumer confidence, well, people seem to be feeling a bit better than I am. It's actually bounced back a bit. Still negative, of course, at minus 19, but less bad than I would have put it at. House prices, according to Nationwide, down 0.1% on the month against expectations of a slight rise, which meant that year on year was at 2%, 2.1%. To my mind, that's actually good news. I'd rather there was no crash and that inflation gradually made houses more affordable. I doubt it ever really works out like that, but for the moment, it's looking okay.
I notice in the press there's a lot of speculation that Rachel Reeves will attempt to go for housing wealth of some kind.
Yes, though
Yeah.
particularly for London and the South East housing wealth, if it's going to be
Mm.
done as based on the nominal value of a house.
Yeah. So watch this space.
UK car production. This is very retro, isn't it, Keith? I feel like I'm in the 1980s here and reporting on car production from British Leyland.
Well,
Anyhow, 69,000 against 69,000 in June, so very stable. But I wonder how important car production is to the UK anymore.
well, that's true, Stuart, but I notice it's half what it was pre-Brexit.
True, yes, yes. UK PSBR actually better than expectations, just minus 1.1 billion. Though June was revised downwards, but I think you've got a section on this, haven't you, more fully, Keith, just about
Yes.
the structural position being rather depressing. Citigroup Economic Surprise Index, well, as close to zero as makes no difference. Indeed, jobs
You
posting.
cynics, Stuart, you cynic.
Well, in place of Richard, I thought that was a nice
Yes.
neutral remark. Jobs postings leveled off. I mean, not
Yes,
considering their decline.
I agree. I think that's leveled off.
What is the REC jobs report?
So
Who's
this
that
is from
from?
KPMG,
Uh-huh.
and it's showing this is the number of job adverts, and it's like the Indeed is showing basically bottoming out. It's
Right,
showing
yeah.
it bottomed out earlier, so it's not really showing any further deterioration.
So when the government says that the UK has had the fastest growth in the G7, oh goodness. Whenever any minister says something like this, it might technically be true, but my goodness, yes, you've had to pick your start and end point, haven't you?
Yeah,
And here we can see the reality, can't we, really?
yep.
So this is a measure of the cumulative per capita GDP change rolling 5 years. And we can see a bit of a bounce for the UK.
Yeah.
Mm.
Mm.
So UK summary, inflation a bit hotter than hoped for, hotter than expected. CPI core up 3.8% year on year. The B of E is forecasting UK inflation will peak in September at 4%. Keith Jordan is forecasting a bit more than that.
Yeah.
Services PMI, well, look, this was genuinely a very good number, up to 53.6. Let's hope that that comes through in real life. Car production has stabilized. Indeed, jobs postings appear to have stabilized as well.
Thank you, Stuart. So while we talk about the UK, let's talk about the welfare state because, yeah, every month we report the UK unemployment rate, and this is the chart. So it's at 4.7%, having risen steadily volatilely because obviously there are concerns about the quality of the data from the UK Statistics Office rising over the past couple of years. But then when you look at the number of unemployed people has been 1.71%. Sorry, it's been 1.71 million for a while now, and actually not really risen. If anything, declined over the last year. What is going on? Well, frankly, a lot depends on how you define unemployed people. And when you look at the total number out of work, you get very different numbers indeed. So when you look at the number of unemployed people, it's 1.71 million. When you look at the people on out of work benefits, it's an astonishing 6.5 million. So almost 4 times higher. So the benefits you see here are incapacity benefits, unemployment benefits, which are relatively modest, and universal credit, which is the new government program which aims to replace all the others. And so you'll see universal credit now dominates in the last month for which we have data. Universal credit over 5 million users, incapacity benefit 1.34, unemployment benefit only 80,000, and other 25,000. And when you look at the total bill for all the health and disability benefits, we are heading to best part of 100 billion by the end of this parliament, steadily rising throughout the parliament. And 7% of working age people are currently on sickness benefits. The Spectator forecasts that will rise to 8% by the end of this parliament, a record.
So Keith, in terms of this chart, if we look at the different big blobs, big zones,
Yeah.
it almost seems like the government does try to reduce the number of people claiming these benefits by introducing a new benefit, getting rid of old benefits, and presumably the new benefits have got different eligibility criteria.
Yeah.
So you get, for instance, you get a reduction, but then as people learn how the systems work, then it grows again.
Yes. And one of the really terrible things the Tories did is that they stopped personal interviews for incapacity benefit. They moved it online, making it much easier to game the system. So when you look at the number of working age people claiming out of work benefits, in some cities, it's an astonishing 25%. So in Birmingham, 25%. Really, these are huge numbers. And around 12% of the population are claiming incapacity or disability benefits. And the personal independence payment is paid to people in work, and that is a new payment. And you'll see here, it's exploded after COVID to
Keith, I
1.6%.
was reading Poor Charlie's Almanac, which is a collection of observations by Charlie Munger, who was Warren Buffett's partner. And he was talking about a benefit system that was proposed to be introduced in California for people who are suffering from stress. And he made the observation that, in the first year, you were identifying people who had stress, that this was a benefit which was well targeted. But in the second year, the third year, the fourth year, the fifth year, what happened was people who were marginal edge cases became eligible because the people judging eligibility felt that they couldn't really say no to this next case, this next case, this next case. And then what happened was you got helpers and lawyers who would advertise how you could, play the system in a
Yes.
sense. So you got these two accelerating factors of marginal edge cases that doctors or other assessors felt that, on a person-to-person basis, they couldn't quite say no. And then people actively, legally playing the system. and the whole thing just sort of exploded in terms of the number of claimants. And you get so far away from the initial intention of the program that his point was, look, yeah, don't have any programs like that. Yes, a few people will suffer, but the consequence of having programs like that is that they get out of control.
I think you need a fallback for the worst cases, hardest cases. But the trouble with having these large programs is that there is no downside to applying. There's all the pressure is to, if you tell a good enough sob story, the pressure is to accept you. So I like you. I think you just, as longer it goes on, the more people get on. Once you're on it, I mean, how much do they come back and kick you off after a period? Don't know. But anyway, the net outcome is that rising number of people are using it. So it is just unaffordable, is the bottom line. And welfare spending on people working age and children is now approaching that of welfare spending on pensioners. Actually, as a percentage of GDP, is forecast to stabilise. We can question this based on
Yes.
what the forecast for UK GDP growth is, bearing in now mind there's currently nout. Now, the PIP I thought was very interesting. So this is awards for PIP post-COVID. It's leapt.
Well, yes, I suppose a couple of years after COVID, isn't it? I mean,
Yeah.
COVID
Well,
was 2020. Yeah.
yeah. So these are the regions with the most people out of work and on benefits. Grimsby, 54%. So you have whole towns that are basically living on half the population living on benefits. Amazing. So the UK government is really struggling to get the benefits bill down, and unless something happens, it's just going to keep on rising. And that means lots of pressure on the PSBR and on the government to keep on raising taxes. Stuart, onto the UK energy price cap. Other good
Right.
news.
There we go. So Ofgem have announced that the energy price cap for Q4 will rise a little bit from 17.20 to 17.55 for a typical dual fuel household, so up only 35 quid. But why is it rising at all, given that electricity and gas prices are down? So what on earth is going on? Well, here we can see the November 2025 gas futures contract that's been trending down from a peak in February. It's down, my goodness, what, 40%? But anyhow, a
Yeah.
sharp reduction. And electricity futures, less of a reduction, but flat to down-ish. So the answer is it's not really to do with the cost of the underlying fuels, it's to do with the net zero related costs. So this is presumably renewable obligation certificates,
Yes.
contracts for different things like that. And
Yeah.
that is what,
Decent.
two-thirds of the overall change in bill anyway.
Yeah. 60%
Yeah.
increase in net zero.
And then if we look at household electricity prices in various countries, well, I'm surprised the UK is only third on this, with supposedly Italy and Germany a bit ahead of us. But it's a big gap, isn't it? France, with its big nuclear program, is, well, sort of three-quarters of our
Yes.
prices. And you go all the way down, the US is less than half of the UK. China, wow, was that
Yeah.
20%?
Yeah.
20% of the UK price.
Yeah. Energy intensive industries in the UK doomed.
So bottom line, the net zero costs are the main driver of this increase in the average household bill. It's not really to do with the cost of energy itself, so be prepared. One small hedge on this, Keith, there are various investment trusts of wind and solar generators who are benefiting from the increase in those feed-in tariffs, the contracts for difference, and the renewable obligation certificate, all of which I believe are indexed to RPI. So there's
Marvelous.
a little hedge if you want.
Great. So, I mean, the thing is, I don't really have a problem with, net zero if we are honest about it. So it's a societal choice to switch to, zero carbon. But you have to be honest about it rather than saying, energy prices are going to go to zero.
Yeah.
You have to say, no, they're not. They're going to double. And on that cheery note, onto the EU. So loans to companies actually growing at a fairly decent rate, 2.8% in line with expectations. Loan to households recovering back to the pre-COVID norm. So that's actually quite encouraging. Households starting to borrow again. Money supply growing at 3.4%. That is okay. Consumer confidence going nowhere. Industrial sentiment going nowhere. Still, moderately depressed, I would say. Services sentiment trending down, but still above zero. But normally the service sector is much higher than it is now, which suggests that the EU economy ain't great. Economic sentiment also going nowhere. Selling price expectations, good news, coming down again. Consumer inflation expectations not, sadly. Construction output going nowhere. Manufacturing PMI actually recovering and above 50 again, which is really surprising given US tariffs, but that is great news. The bad news is that services going nowhere, hovering around 50, and that is a weak number by historic standards. The composite, therefore, just above 50. Negotiated wage growth, thought this was be lower than it is, but in Q2 that was best part of 4%, not great. Economic surprise index, well, Eurozone being resilient actually. Indeed, job posting index, I don't think you can say that's stabilized. That looks like a continual downward trend. France still falling. EU summary, well, stagnation really. The inflation is back down to 2%. The economy is not going anywhere. And you've seen that the Finnish governor on the ECB has been talking about how they may continue cutting rates at the next meeting. On to the US, Stuart.
So US GDP growth quarter on quarter annualized, well, a whopping 3.3%. Thank you very much. Against
Now,
expectations of 3.1, so not bad at all.
yeah, but most of this, frankly, just as that, like the minus 0.5 number in Q1 was all due to a surge in imports.
Ah,
That is the surge in imports abating, so the net foreign balance improving a lot.
got it. Yeah. Right, which I think is what you're showing here, isn't it? Yeah.
Yes.
So
So
you get, yeah, the national accounts wanging around as imports and exports change dramatically. Corporate profits quarter on quarter annualized, up 2%. Yeah, obviously this is very different from S&P 500 earnings, isn't it? I mean, that rate of change is very different. I guess you get a lot more medium and small companies in the national accounts, which also will be not including the international profits of the mega caps. Real consumer spending, 1.6%, well, perfectly acceptable.
but not great. Actually, well down on, last year.
Inflation measures, PCE inflation month on month, 0.2%, which makes it 2.6% year on year. So totally fine.
Yeah, totally fine. Not really coming down, but not rising either.
Yeah. Core PCE perhaps ticking up a bit now at 2.9%.
Yeah.
Not going to stop the Fed from cutting, I suspect.
Mm.
So US manufacturing prices are rising much faster than their EU equivalent. So presumably this is tariffs, isn't it?
Yeah.
Somewhat complicated Z-score measure, but I think, yeah, I mean, the point isn't really comparing USA and Eurozone. Eurozone
Yes.
sort of flat. Financial services prices were responsible for the rise in supercore PCE inflation in July. Well, there's quite a complicated bar chart there, but I think, are we looking at the green bar there?
We are.
Yeah.
Yeah. So what that's saying is part of the rise in inflation was the rise in financial services fees, which are indexed to equity prices. Equities go up, inflation goes up.
Oh, I see. What people taking a percentage share of investors' assets.
Yes.
Right. US manufacturing PMI dramatically better than expected. At 55, that's the highest it's been for a couple of years, and knocked expectations out of the park. Services PMI also pretty good, 55.4. I mean, we have been seeing various possible indicators of the US economy slowing down, but both of
Yeah.
these PMIs are pretty damn strong.
Yeah. No, it's recovered. We thought back here that it was going to slow down. It ain't.
So the composite, bringing those two together, 55.4, pretty strong. Yeah. Durable goods orders month on month were down only 2.8%. Expectations had been for a fall of 4%. Chicago Fed National Activity Index, not too healthy, minus 0.19.
Yeah. Reminder to everyone who's unfamiliar with this, it's measured in standard deviation. So it's showing that the US economy is expanding at less than its normal rate.
Consumer confidence, not looking too healthy on this measure at least. House prices, expectations had been for a small month-on-month increase. In fact, they were flat. So year-on-year inflation, house price inflation of 2.1%. To some extent, coming back down to earth after the unexpected strength, really. Building permits, oh, this is trending down. It, in a sense, has been surprisingly strong for a couple of years despite rising rates, but perhaps inventories have been worn down, and new building permits not very strong, 1.35 million.
I agree, that's trending down, Stuart. But then,
Housing starts, right?
yeah, they ain't. So, you know, does that mean in future housing starts will slow? But, currently they're not.
Yeah, well, that's logical, but the housing market hasn't really been very logical, has it, since
No.
rates were jumped up? Existing home sales, well, I think the big picture here, they've taken a real beating and taken a big step change down. They're now at 4 million, which slightly beat expectations, but I think the big point is the big change since 2022 and rate increases.
Yes, exactly. So people who have an existing mortgage, I mean, they've remortgaged it at, 0.5% or something back in COVID, and now it's 6%. I mean, you just can't move house because you have to get a new mortgage. So nobody's moving house. And actually, that has quite a big knock-on effect for the economy because when you buy a new house, you tend to buy new furnishings, etc., etc. So if long-term rates do come down and the housing market picks up, that should increase durable goods spending.
US new home sales, they've been reasonably resilient, haven't they?
Yeah.
0.65 million in July, and no real trend, I would say there. That looks pretty flat. Falling lumber prices in the US do not suggest a strong construction market. And obviously these were a big feature in COVID, weren't they? And the
Yeah.
subsequent inflation. But it's absolutely collapsed, hasn't it, lumber prices?
Well, it's only our past couple of months and it is volatile,
Mm.
but you know, the US market has been surprisingly strong for the last couple of years. I just don't understand it. How the actual activity, when you look at it from the national accounts, has actually been falling for months now, but jobs have actually been rising still. I just don't get it.
Well, there's construction and there's construction, isn't there? If you're talking about building houses, yeah, then yes, maybe. But if you're talking about building data centers or
True.
some of the other activity that the Biden subsidies supported, then that's probably where the activity is. Initial jobless claims, I think no story here really is there, 230,000.
Yeah.
Continuing jobless claims, well, after the run-up that we saw in the spring and early summer, they've sort of leveled off but not gone back down. So not a totally
Mm.
encouraging picture there. Indeed, jobs postings, well, sort of flattening off really, isn't it? Right, the decline in linked up job postings appear to have slowed. So is the labour market bottoming?
Yeah.
Turning now to the short-term nowcast forecasts from the Dallas Fed, for instance, 2.6% compared to last week, 2.5. So, pretty stable. The Atlanta Fed GDP now at 3.5 compared to 2.5 last week. Again, we always have the import-export issue, which I think is particularly acute for the way the Atlanta Fed calculates it.
Yeah, completely agree.
So talking of which, do plunging imports once again equate to a high Atlanta Fed GDP forecast? Because reduced imports would increase your GDP forecast. And that is one hell of a step change down. US imports from China heavily reduced.
I know. Yeah, I thought it was stabilizing, but
Yeah.
it ain't.
The New York Fed GDP nowcast 2.2% compared to last week 2.1%. A lot of data and showing the error bands around their forecast, but I think all of them are coming in at like 2.5%, isn't it?
Yeah. So US economy pretty stable, growing at a rate that we would be very happy with.
Absolutely, yeah. And finishing that off, the St. Louis Fed for Q3, 0.5%, where last week they were forecasting minus 0.3. Goodness.
Yeah, an outlier there.
Yeah. Citigroup Economic Surprise Index has bounced up a bit, which I think that's sort of perhaps what we've been saying from some of these PMIs, etc.,
Yes.
that things are a bit better than they were looking earlier in the year. US Trueflation stepped up and then stepped back down, 2%.
Yeah, that's fine, if true.
Right, yes. This I thought was a very interesting chart that I saw in the commentary from Lynn Alden, because it wasn't just looking at year-on-year changes, but looking at the nominal amount of construction spending. And you really do see the massive change from about $6 trillion. Is that right? Am I getting my units right? From 2015 to 2020, up to 18 trillion. So an absolutely monstrous increase, which she was, I think, putting down to all the IRA and the CHIPS Acts that from Biden having a
Yeah.
massive impact.
Yeah. But, again, it's peaked and come down, but construction jobs not still rising. I don't understand it.
US consumers think that the jobs market is not good. We can see that in measures of jobs plentiful, which has been falling, and jobs hard to come by measure, which has been nudging up a bit. So I think most people are sitting on their hands if they can, not particularly looking for or expecting to be able to find another job easily.
Yeah, but they're still somewhere apart.
Yeah.
Most people think the job's plentiful. They need to cross really for start to get concerned.
Well, here's a very interesting chart. I've been reading and hearing a few comments about the return of the K-shaped economy in the US after COVID. The idea that the economy has bifurcated, the rich doing very well, and this is what the chart here is showing. The top 20% of earners now make up over half of consumer spending. And conversely, those at the other end of the spectrum really suffering.
Yeah.
I think you like this chart, don't you, Keith? The tariff revenue is now getting to an annualized 335 billion. I mean, it remains to be seen. The numbers keep wanging around, and the implementation details are terrible. I mean, I would hate to be importing, exporting it. It's an absolute nightmare when you can have a headline agreement, but then none of the details have actually been fleshed out. But anyhow, one upside for Trump has been a big increase in tariff revenues, which should take the edge off some of the increases in the deficit that would come from the big beautiful bill.
Well, frankly, so far, Trump is winning in my books. So he's making a hell of a lot out of tariffs. The S&P 500 keeps on rising, or because although manufacturers and consumer goods companies presumably are suffering, they're being driven primarily by the tech stocks, and inflation hasn't really taken off. So it seems like he's made a hell of a lot of money from tariffs without that many consequences.
Yeah, I mean it's well, we're less than 1 year in, aren't we?
Yeah. Now,
We
I know
talked.
we know that there's a huge inventory build-up, so that's going to be fading, and then manufacturers or companies will start to pass through tariff costs. But let's see. So far, there have been very few consequences for them.
Yes, which I think is what this chart is showing, isn't it? EPB research have said the deficit has shrunk by 1% over the past 2 quarters due to additional revenues from tariffs. So, yeah.
Now only minus 6.4%, Stuart.
I
That
know, at the peak of an extraordinary boom for the
exactly.
markets and for the economy. Yeah.
Yeah. During the good times, 6.4%.
Well, yeah, so talking of which, debt to reach unprecedented levels. Yeah. So the CBO forecast for in January 2025 had debt in 2035 reaching 120% of GDP. You make a few adjustments to that, more realistic ones, and you can easily get up to over 130% of GDP. I mean, structurally, the situation is awful, but as you say, cyclically, Trump won't care.
Yep.
Yes, I think one little impact of this that's probably very annoying to consumers and small importers is the fact that you used to be able to send parcels, and I think it was under $800, you could just get them in and they wouldn't really be checked. But that was leading to a lot of abuse of the system, I think, by a lot of the Chinese mass manufacturers, and not just of consumer goods, but of small manufactured goods as well. They would target things below below $800, and they would just get in at zero tariff.
Yeah. So, but again, this is bad for consumers,
Yep.
good for Trump and his tariffs.
Japan's trade envoy postpones his trip to the US as Tokyo wants faster action on the tariffs deal. I'm sure that they just cannot believe the amateurism of the US government and the lack of attention to detail. I think for a Japanese bureaucrat, they just couldn't believe that you could
Yeah.
get away with this without being fired. But that appears to be the way the US administration runs at the moment.
Well, my point is, Stuart, that, Trump announced this trade deal with Japan, but
Yep,
actually they're not really deals. They're just sort of outlines of deals.
exactly. Yep.
So,
Well, we covered the welfare state in the UK, which is notoriously a welfare state, but the US has also got a similar sort of position. Social benefits now account for nearly half of US government spending. So social security, that's begun to pick up, and obviously with the demographic profile, that'll increase even more, as will Medicare and Medicaid. So 46% of US government current expenditures are what you would call, or what we would call the welfare state.
so actually, just returning to the UK briefly, I was running on Sunday with an architect, and he was talking about how the planning system in the UK really doesn't work anymore. So he was putting it down to councils having hollowed out their budgets, particularly during COVID. So every in the basic problem in the UK is that everything is being cut apart from welfare spending, leading to departments such as the housing department being under-resourced. And particularly in COVID, everything got cut to support welfare spending. And then after COVID, the jobs didn't come back. So you find lots of dysfunctional housing departments in UK county councils.
Right, contrary to what you might have heard, foreigners have still been buying US assets and in record amounts in 2025. So equities, yes, well, I suppose we're not too surprised as well, I heard a nice analogy the other day talking about investors really being like a bunch of 7-year-olds playing football. They
Yes,
just chase after where the ball is, and unfortunately, it has sort of been working.
it has.
Um,
Yeah.
so equities, but also treasury notes and bonds, which is a big issue in terms of the sustainability of the US deficit. But yeah, no crisis at the moment. Declining fiber box shipments suggest that manufacturing demand remains weak and is weakening.
Yeah. So, if you're shipping goods around the country, you need boxes, but box
Right.
demand is falling.
So the US summary, PCE inflation was in line with forecasts. Headline rate was flat at 2.6, core was up to 2.9. GDP Q2 was revised up to 3.3 annualized, and the composite PMI was 55.4. So US economy does appear to be growing pretty steadily. and non-farm payrolls are out on Friday. Obviously, there's concerns about the quality of the statistics, but it no doubt will move the market one way or the other.
Thanks, Stuart. On to China. Manufacturing PMI slightly weaker than expected at 49.4. Services in line with expectations. Dead, basically. Dead on, like 50. General, the same. So economy not really going anywhere for a long time, according to the PMIs. Foreign direct investment still falling, having been falling for a long time now, actually. Industrial profits down 1.7% year on year. All that just not great. But when you look at, so we know the official statistics. When you look at statistics looking at the underlying economy, such as total electricity generation, well, that keeps on rising enormously. And if electricity consumption is a function of GDP growth, well, you'd have to say the Chinese economy is doing just fine, actually. Not necessarily the world climate, but the Chinese economy. So China's got literally 0% inflation, and the economy's perhaps growing in line with, actually, we don't believe it's growing at 5%, but it's growing. Okay, on to one chart. Now, this is freight costs around the world, and they're declining again. So this suggests that tariffs are very much having an effect, that global trade is not going anywhere, is declining. So tariffs are having the effect of certainly reducing world trade. And global economies ain't doing that great.
And that also included the Shanghai to Rotterdam route, not just routes to the US.
Yes, well spotted.
So as part of our ongoing coverage of AI and all the various models, here's a little review of what Deepseek has been up to with their latest model, version 3.1. So it didn't have such a fanfare launch. It's the DeepSeek's competition to ChatGPT 5. It's an open source programming language. It's optimized for Chinese chips, and it's priced very much to undercut OpenAI. So this version 3.1 has 685 billion parameters, similar to many of the top American models. It has a mixture of experts design, meaning only a fraction of the model is activated when it's asked a particular question. So it doesn't have to sort of be overly computational. And unlike earlier models that split the tasks that could be answered instantly, separating those that needed a step-by-step reasoning process, this version combines both fast answers and reasoning in one system. So here's more details laying out all those numbers. So now I'm looking at different measures of its ability. So Deepseek 3.1 is the left-hand bar here, measured in using the SWE bench verified code bug fixing test. And now it wasn't the best, but it wasn't too far off. ChatGPT 5 scored 75, DeepSeek scored 66. Claude Sonnet was the other very good performer at about 73.
Yeah.
But I think that the point to me was all the models were sort of within a range. No one was really a standout performer. Now, a different test is the IDA polyglot test, which examines the ability to complete coding exercises in many different coding languages. So Deepseek 3.1, it's fourth on this list, but it's not too far off. Gemini, GPT-5 and Grok 4, which all did a bit better, but it's not too far off. And it was definitely better than Claude Sonnet and an earlier GPT model. That IDA programming test, DeepSeek not only scored slightly higher than the Claude Opus, but, and this I think is the key point of your slides here, Keith, is that it was massively cheaper, 68 times cheaper. So I think that this is sort of what we're nudging towards, that it might not be the very best model in terms of performance, but it's not too far off. and it's incredibly cheap to run. It's really been optimized around those chips and the extra computation that it doesn't need to do to answer questions.
That's the point of this whole thing, Stuart.
Yeah.
That DeepSeek have released this on the quiet, and the performance is very good. It's not exceptional, but it's dirt cheap.
Mm. So trying to quantify that, if we look at the code generation cost, DeepSeek was $45, Claude Opus $3,000. A review of the code, $22.50 compared to Claude Opus $1,500. And debug assistance, $13.50, Claude Opus $900. So it's just wildly, wildly cheaper.
Yes.
So if you compare ChatGPT 5 and DeepSeek 3.1, well, it's sort of the same story, that the intelligence is, depending on this particular measure, it's not quite as good as GPT-5. It's scoring 60 on this measure compared to GPT-5 scoring 69. It's also quite a lot slower, but it's just so much cheaper. You can completely imagine it hoovering up lots of activity, which doesn't have to be the very cutting edge.
Precisely.
This I thought was interesting, which is a measure of the headcount over time by age group of software developers. And this really shows the impact that the various AI models are having in coding, and in particular in the early career coders. You can see a massive impact in the blue and the orange lines, which are early career coders, people in their 20s. They've been massively impacted. Older developers, older coders, much less so. So this is the issue where if you are an intelligent user and engager with the AI models, getting them to correct and create code, and you engage with it properly, you can be very, very productive. But it's eviscerating the early stage coders. Of course, the fear is that this is going to do the same in many other professions.
Yeah. So currently AI, has the ability of a low-level coder, and so it's replacing these people. As it gets better, you think it's going to eat everyone's lunch.
So bottom line, the AI models are continuing to improve, and their capacity per dollar will also continue to improve, and the US will not have a monopoly on AI. So who will make the money? Well, the chip manufacturers, obviously at the moment that's NVIDIA, but the Chinese government is massively incentivizing their chip manufacturing industry. The infrastructure firms are building all the data centers. Power companies, as power demand increases. But the AI companies themselves seem to be trapped on a very expensive treadmill. They've got continual improvements in the models, but no one is taking a step change ahead of anyone else. So it's going to be a very competitive market. And will all the incremental advances justify the massive increase in investment that is being required?
Yeah, I just don't think so. I think they're really going to struggle to make money because they're going to be, why pay for cutting edge AI model when you can get the last generation cheap, or you can use DeepSeek for peanuts. So we'll see, but I wouldn't have thought they don't have a big economic moat in the way that, say, Google and Microsoft does. Microsoft, you have to basically use, Microsoft Office, but you don't have to use ChatGPT. You can use DeepSeek or you can use Grok or whatever.
So we talked about infrastructure, but let's have a bit of a deeper look at the economics of AI data centers. Capital expenditures from these big four have absolutely ballooned from what perhaps 40 billion a year in 2023 to approaching 100 billion. And these companies were famous for being capital light models, throwing off oodles of cash every year. And now that is fundamentally changing. They're throwing billions at their capex budgets. Both AI and non-AI workloads are going to be key drivers of global data center capacity demand through to 2030, according to McKinsey, but I'm sure not just them. So we can see both AI and non-AI workload zooming up massively in terms of the gigawatt capacity demands. So 3.5 times change between 2025 and 2030, according to McKinsey.
Hum.
Yes, well, true. Um, and we're beginning to see some impact of that on the US city's average electricity price, which has zoomed up since 2022, up what, 50%?
Yeah. Yeah. Well, best part of, let's say 40%.
Yeah. So if you expand that out globally, the worldwide data center creation is oh, this is a new one for me. We've got now up to zettabytes. So that's
Yeah.
1 billion terabytes.
Yeah.
So back in the old days of 2020, 47 zettabytes were needed. The forecast from CBREIM is that by 2035 we'll have reached 2,142. So, I mean, that truly is an exponential growth, isn't it?
Yeah. Yeah, absolutely. Well, clearly, if you keep on doing an exponential growth at this rate, you get to absurd numbers.
Yeah.
So at some stage, this exponential chart has to be wrong. But what they're saying is we're all creating vastly increasing amounts of data, and that data has to be stored somewhere.
So AI data center is propping up US GDP. So trying to get a sense of the orders of magnitude here. US nominal GDP this year is around $30 trillion. Now, NVIDIA's sales to data centers is an annualized 156 billion. And now the percentage of NVIDIA data center sales that is AI related, right, basically is all of it at the moment. But NVIDIA's share of data center capex is, let's say, 25 to 35%. The land and buildings for a data center, also 25, 35%. And the rest, the power systems, the wiring, the cooling, the racking, etc., let's say about 40%. Always this issue of the economic multiplier. What other economic activity do you instigate from whatever you're doing? So if we estimate that at 1.5 to 2 times, this implies that the total data center capex is something of the order of around 500 billion. And that's in a market, a nominal GDP of 30 trillion. So 30 trillion GDP, NVIDIA data center capex, say 156 billion, but that's only half the market. That implies the total data center capex is over 300 billion. That's 1% of GDP. But if you think there are spillover multiplier effects, then if you think the multiplier is 1.5, you're now getting at 1.5% of GDP or up to 2% of GDP. And this is just on the data center side.
Yeah. So data center expenditure is absolutely having an effect on the US economy.
Oh, this is a nice chart, isn't it? Putting it into the context of, for instance, the 19th century railroad boom, which was 6% of GDP, but the telecom boom of 2020 was half this, about 1%. So AI data centers between 1 and 2% of GDP is massive.
Yeah. And obviously forecast to keep growing. But, is that true?
Well, yes. So talking of which, here's the telecom service providers capex, which was also going exponential between the mid 90s and 2000, rising from under 40 billion to over 120. That didn't continue, did it, Keith? As I remember, and as we show
Absolutely.
in the chart here, a huge step change down, a sort of close to a sudden stop. It collapsed in 2001, 2002, and that caused a recession.
Yeah. Absolutely. And so there's just huge amounts of malinvestment, building these huge undersea cables to carry, telecoms data, and there's just overbuilt. The actual volumes weren't enough. And actually, when you look at total telecom spending, I mean, and remember the spectrum auctions, disastrous for the telecoms company. Everyone was forecasting massive revenue growth, but actually competition just ate all those revenues away. They didn't have pricing power. And I suspect the same will be true. And we are in the mania phase.
So if we try to look at a data center in a bit more detail, is the investment economic? So we were estimating about a quarter of the cost was land and buildings. So, okay, we can have a long depreciation period for that, up to say 30 years. The GPUs, well, that's going to be about a third of the cost. And the rate of improvement in the GPUs is massive. So you're going to have to change them out every few years. So you could perhaps assume a depreciation period of 3 to 5 years. I would probably suggest it's the lower end of that.
Yeah.
Then you've got all the rest of the gubbins, power systems, wiring, etc. You could hope to depreciate that over 10 years, but again, technology is changing very rapidly, maybe less. But if we take those numbers as a good central estimate, you've got a weighted average depreciation period of just under 13 years. Now, if we start looking at a bit more detail of what's being spent, so 2025 data center investment was 312 billion. So the depreciation cost each year should be at least 24 billion. I would argue a bit more, but let's say 24. But the estimated data center revenue in 2025 is 15 to 20 billion. So 2025 revenues, and that's revenues, not profits, doesn't even cover the depreciation cost. So what would a data center's revenues need to be to cover at least the depreciation? So if we assume a 40% profit margin, which is still pretty chunky, you'd have to have that 24 billion depreciation divided by 0.4, you'd have to have 60 billion of revenue. So at a 40% profit margin, the industry would need to at least treble current revenues just to meet depreciation expenses. So
Yeah.
it just seems fundamentally so far off.
Yeah. Now, all that data is for, GPUs like AI data centers. So I thought, well, all that data was from Cuppy and this guy, Paul Kidrowski. I thought, well, what about existing data centers? Are they profitable? So I had a look at Equinix. Okay, so Equinix run data centers, and they manage the cloud computing for all these brands. Big specialist data center provider, and this is their latest results for June 2025. Revenues of 2.1 billion. The cost of those revenues, so electricity, etc., immediate costs, that's 1 billion. Gross profit is 1.2 billion. Then OPEX, wages, etc., gets you income is decent. That is a 25% profit margin. And then, interest, etc. But you have very good net profit margins. Included in that was depreciation of 502 million within net margins of 17%. So actually, depreciation isn't a problem for the existing data center businesses. And we can back out the depreciation period, which is 18.3 years. So GPUs probably have a shorter life than CPUs. And so I think 18.3 is probably justifiable. So let's see what happens if you were to depreciate them over 12 and a half years rather than 18 years. Well, it does eat into your profits. Actually, it does cut your profits by quite a lot, but it's still not a disaster. It's not losing money. I like your opinion on this, Stuart. So Cuppy, who this all comes from, was saying that AI data centers are currently unprofitable and that after allowing for depreciation are never likely to be profitable. And a lot of that depends on the assumption that the GPUs have a very short life because they're being replaced so quickly. And therefore, he's saying the current AI data center boom is a massive misallocation of capital, which can never be profitable and must collapse. But when you look at existing data center providers like Equinix, they've got really good gross profit margin, 50%, net margin 35%, and is profitable even if you you decrease the depreciation time and increase the depreciation charge. So, not sure, honestly. What do you think?
I'm surprised at how sensitive things are to the depreciation. Perhaps I shouldn't be, the more I think about it. But I know you're pointing out that Equinix is still profitable if you change the depreciation years from, was it 18 to 13?
Yeah,
But well, it was, but profits were down, 2/3.
true.
So for something to be so sensitive to an accounting assumption over which you can't really be sure because the technology is changing so fast, I would be leery of a data center. I mean, obviously it depends what you're being asked to pay. What is the
Yeah,
stock price?
because
Now
the other
this is
thing. Sorry, go on.
sorry, this isn't, I think, your main point. But I also noticed that there was quite a bit of a stock-based compensation charge in
Yes,
the
I know.
Equinix numbers that yeah, which I think
Yes,
is a very American thing. But
yeah.
I know it's not really your main point, which is about depreciation. But I mean, how if there's plausible arguments for 88 years or 30 years, it makes such a difference. And how can you know?
But because the other thing, Stuart, though, is they're building like just vast amounts of this,
Yeah.
and there's going to be a supply shock. Is there going to be sufficient demand? Everyone's extrapolating demand. I wonder why,
Yeah.
I'd like to see the results before
Well, I suspect it's going to become slightly self-limiting just because of the electricity supply problems, which I th think have got very, very good coverage, and the
yeah,
need for either nuclear reactors or more likely gas-driven turbines to support them, and that might slow down the process, so you don't quite get the boom that people are hoping for. Just the day-to-day realities, you can't just go at the rate that you want to.
yeah. Okay. And final big section. So thank you very much to our Discord member, Muscle Riot, for putting me onto this. So now apparently AI can resurrect dead economists. So you ask
Good
them,
news.
yeah. So you ask them a question, what would um, John Maynard Keynes think about this? And he was, spew out the answer. So last week I was talking about how if inflation came down, UK bond yields would come down, and he fed that question into AI and asked what the Austrian economist from the 1930s, who I'd never heard of, Felix Somary, would have said about that. And Somary's point is that when a country's fiscal position deteriorates beyond a certain point, bond prices are driven primarily by the state's credit status, not by inflation expectations. So, if the market thinks that UK credit is sufficiently bad, then you can get inflation down and bond yields won't come down because they'll be more concerned about the credit status of the company than there will be about inflation. So, Felix Somary's diagnosis of the UK's current predicament via AI, and thank you to Muscle Riot for doing this. So, now I should say, actually, this was really interesting. The AI got all the numbers wrong. And so we had to, other people, PHS on the Discord, and everyone went through correcting this. But anyway, so in 2024-25, the OBR's central forecast for the fiscal deficit is 4.8% of GDP. But the AI is forecasting that by 2070, health and pension spending will be around 22% of GDP, and that there is a political system in the UK which is incapable of denying benefits to an aging, high turnout electorate. I struggle to disagree with the AI on that one. And so the AI is saying that Felix Somary would have said that lower inflation would not reduce gilt yields because lower inflation implies lower growth, and lower growth implies lower tax revenues, worsening the deficit as long as the policy remains unchanged. And obviously, the assumption here is that we have a political system incapable of denying benefits. So it says when recession reduces the tax yield, the state has only two choices: default openly or default by inflation of the currency. Markets will demand a premium for either risk. I thought that was a very good quote, actually, directly from Somary. This is from the OBR. It is central scenarios for UK pension spending. We've talked about this before, how the triple lock is just an absolute total disaster, and nobody has the courage to stop that and actually just move to an earnings rating system. But if the triple lock stays in place, then UK pensions cost is going to go absolutely ballistic. And so Somary currently is dead right. The government knows this is a problem, lacks the courage to do it. So my first question was, okay, if Somary is right about this, then why didn't the yields on JGBs explode over the past 20 years when Japan, frankly, has been a fiscal basket case? So this is Japan's debt to GDP ratio, twice that of Britain's. And for much of that period, JGB yields were actually falling. Obviously now it's going through the moon, but for much of that period, it was falling, and I would observe it's only taken off when Japanese inflation has taken off, implying that actually bond yields are not a function of the sovereign debt credit rating, they're a function of inflation, which is what I'd said. So Somary anticipated Japan's situation. So in a 1957 memo, he argued that the risk premium can be suppressed as long as all or nearly all the debt is held internally. Domestic savers then have no alternative. Domestic savers have no alternative large-scale store of value, and he assumed there that there'd be capital controls. So then domestic savers are financially repressed to go and buy all the debt. And he says, the AI says, that Japan met both conditions. 90% plus of JGBs were held by Japanese banks, insurers, and the Bank of Japan. Cultural inertia kept savings at home. So the result was the risk premium migrated from the bond market to the yen, and the yen depreciated over that period. When domestic savers can no longer preserve the paper, the state does not default in coupons, it defaults in the FX value. So what they're saying is, over the period, the yen took the strain and fell. But the thing is, it didn't. And I tried to get the AI to fix this, and it wouldn't. It kept on saying that from the period, you can choose the data points. So it'd say between 1995 and 2015, the yen weakened substantially, but you're picking data points there. Over the period, I'd say that's broadly stable. So to me, I was unconvinced. I don't think Somary's narrative does fit that of Japan. So JGB yields fell even as the deficit widened and the debt reached 200% of GDP. What Somary didn't anticipate was the continual intervention of the BOJ through QE, massively buying Japanese bonds and keeping the yield curve artificially low. So bond yields basically became a function of where the Bank of Japan wanted them rather than market prices. And over that period, the yen was broadly stable, actually, I would say, although volatile. So instead, it seems to me the recent resurgence of inflation has been the cause of rising bond yields and the falling yen. So I'd say that Japan does not seem to have yet entered Somary's sovereign credit doom loop, despite having twice the debt of the UK. Although you might say that's happening right now when bond yields are rising so fast. So asked it another question, actually. Musselwhite asked it this question on my behalf. So even if the UK's credit spread is widening, why can't the UK just simply borrow short? So, the credit spreads mean that the 30-year yield rises, let's say 10%, but the Bank of England's rate is at 2%. So the government just borrows at 2%, doesn't need to borrow at 10%. Somary warned about just that sort of temporizing strategy, and he calculated that it would only delay the inevitable by 2 to 4 budget cycles. When the Treasury begins to shorten the maturity ladder, it exchanges interest rate risk for refinancing risk. True. Currently, between 28 and 31% of UK debt is held by foreigners. That's the OBR, not the AI, which is low compared to Italy or Greece, but very high compared to Japan, i.e. the UK needs foreign capital to fund the deficit. And if the credit risk rises, then even at base rates, the UK will struggle to fund its deficit. The exchange rate will fall because there'll be insufficient flow of capital into the country. It won't be attractive enough. Inflation will rise because the exchange rate is falling. When domestic savers can no longer absorb the paper, the state does not default in coupons, it defaults in foreign exchange value. And I made the other observation that the UK government has agency. It can raise taxes or cut benefits to reduce the deficit. But this is Somary's point about the UK not being able to take on its own aging population. The markets price in the probability of reform, and what the markets would be saying is that they don't think the UK can reform. The UK government has shown itself unable to cut pension spending or spending on the NHS, and both of those are forecast to keep on growing in the coming years. Tax rises are capped by the Laffer curve, and as we've seen, any tax rise the Labour government is contemplating, and it is not doing the sensible ones like raising income tax, it's doing things like raising CGT, with the result that CGT yields have actually gone down because everyone thinks they're unfair and is simply not selling the assets and waiting until a new government comes in and reduces them again or something. So with all that in mind, what is the UK's current fiscal position? Is it so bad that Felix Somary would be saying that we are in a crisis of confidence leading to elevated and irreversible credit risk? So the OBR forecasts the current fiscal deficit as 4.8%, falling to 2.1% in 4 years' time. If you exclude investment spending and just look at the current budget, the OBR is forecasting that the current deficit will fall from 2.1% of GDP to a surplus of 0.3% by 2029. So not disastrous. And public sector net debt really is going to be roughly stable over the course of this parliament. But of course, that's the amount of debt held by the public will continue rising because of QT sales by the Bank of England, which we have discussed many times. Income tax rates, they're high, but they've actually come down over the last 40 years, and there's still room for them to rise. Although, of course, the Labour government has pledged not to do so. The overall tax burden is the highest it's been since the 1970s. Part of the problem with the UK is it's moved from corporation and income taxes towards stealth taxes like VAT, national insurance, which distorts work incentives more than headline rates. Difficult to disagree with that. The tax burden is actually not enormous. I know it's a huge, no, it's at a high compared to, Britain's rates historically, but we're here. The G7 have tax burdens that are higher than us on average by a margin. The UK could raise taxes if it wanted to. And when you look at Denmark, Denmark has tax rates which are over 10% higher than those in the UK. Tax rates in the UK compared to G7 average, compared to the EU 14. So the UK certainly has room to raise taxes higher. And when we look at government debt as a percentage of GDP, yeah, it's bad, but, it's not as bad as the US or France, nowhere near as bad as Japan. So I'm skeptical. Debt interest spending has increased. That's not good. But again, it's below the highs of 1980s or the 1950s. And when you look at our sovereign credit rating, it's okay. It's below that of Germany and the US, but it's not disastrous. And the last move by both Moody's and the S&P was up. So the credit rating agencies think that actually Britain's credit has been improving. And when Somary talks about the sovereign risk turning up in a falling exchange rate, well, it ain't falling. It's actually risen since the disasters of Liz Truss's budget. So I just don't think the UK is anywhere close to entering Somary's sovereign credit doom loop. And I thank him very much for Muscle for putting me on to Somary. I've never heard of him before, but fiscal deficit is actually forecast to fall to 2.1% of GDP if Rachel Reeves follows through with her promise to balance the books. Big assumption. Taxes will rise to 35% of GDP, but that's still low by G7 standards. The UK has room to raise taxes if it has the political courage to do so. And the debt to GDP ratio is forecast to be broadly stable rather than increasing like in the US or France. Credit rating not deteriorating, sterling broadly stable. So bottom line is, I think the increase in UK gilts has been caused by increased inflation, expectation and uncertainty over the long-term path of inflation. It's not been caused by concerns over the UK's sovereign credit risk, and also it's been driven up by increased issuance, particularly from QT, reduced demand from pension funds. So bottom line, I stick with my prognosis that if UK inflation comes down and the UK cuts the deficit as expected, gilt yields should come down. Stuart, your thoughts?
Yeah, there's a lot in there, isn't there? I'm quite struck and sort of persuaded by the overall model that he presents, that
Yeah,
it makes sense, and I guess it's particularly appropriate for an emerging market situation. And then the question becomes, have developed markets become like emerging markets? And your analysis suggests that, look, we're a couple of steps down the path, but we're not really near that at all,
I agree.
near a real, crux. Be interesting to see what the UK situation was in, what was it, 1976 when we called in the IMF?
Yeah,
What the various ratios were there. Because I agree, I don't think that both on the macro numbers there, but also in terms of the social position, we're at the grumbling, complaining stage. We're not really red hot as a society saying, look, this can't continue. We're the proverbial frog, aren't we? We're
Yeah.
slowly boiling, and we're not. I mean, the FT comments section is always full of people complaining in the way that I would, but we don't have a wider social um, acceptance that there is a problem.
Mm.
And obviously MPs don't think we've got a problem. I noticed Rachel Reeves, she set up an internal communications unit to try to educate her own MPs about what these
Yeah.
statistics were, what they meant. So I don't think we've reached a broader stage of recognizing that there's a severe problem, and therefore we won't have the political will to do anything about it. So I think we're more likely to keep going down Somray's path, but it's years off.
Yes, I
But,
agree.
but your Japan example was fascinating, wasn't it? I hadn't appreciated that the yen hadn't been as weak as I assumed it had been, that it would seem to be the poster child for this sort of model, wouldn't it? But and in case it's just a sort of real exchange rate versus nominal exchange rate issue, and but the nominal exchange rate didn't show that depreciation, did it? It was
I
quite
agree.
extraordinary.
Well, the central bank was very successful in suppressing bond yields without having much effect on the currency. It's really surprising. But then Japan's a net exporter, so
Well, I think that's a big issue that they did at the time have a current account surplus, but
yeah.
I wonder if there's also that popping of a bubble issue where um, no one would touch equities, no one would touch real estate in Japan after the popping of that bubble. So you definitely did have a crowded in domestic capital base,
Mm.
and there was nervousness about investing abroad as well. So I'm slightly struggling with it because in a sense, want the model to be right.
Well, I think if you think about, let's say, Greece, the Greek debt crisis started with them admitting that they had been cooking the books. And then essentially, no matter what they did with interest rates, they couldn't
Yeah.
attract capital. And so, that is the emerging markets model. And yeah, obviously in the case of Greece, the exchange rate was fixed. In the UK, it would turn up as a run on the pound.
Yeah.
Now, the thing is that when we look back at the historic data for the UK, a lot of it is misleading because there were capital controls. And so, it wasn't a free market system. The exchange rate wasn't floating as it is now for
Mm.
pre-70s. And when you talk about the IMF crisis, Tony Benn was for not calling in the IMF. He was for going full Stalinist, capital controls, keep on spending on the unions, etc., etc. Thankfully, the rest of the cabinet overruled him, and actually, the UK repaid the loan well within the timeline agreed. So, bottom line is, I stick with my disastrous so far forecast that if, so this is a big if, I thought it was when, but it's now if the UK can get inflation under control, bond yields come down. And while we talk about that, the next year, have you seen that? We have got UK tightening the fiscal deficit by, was that 2.5% of GDP, 2.7% of GDP over the next 4 years? That is um, will tend to slow the economy. How are you going to stimulate the economy? You could either the exchange rate is going to go down, or probably both, interest rates are going to go down. So that would be my prognosis. Or, of course, the Labour government fails to deliver fiscal tightening. That's the other alternative, and we have endless stagflation. So here's hoping that doesn't happen.
Well, my bottom line is that this releases my inner Richard Wheater, and this is more arguments for gold.
No, that's true. Well, he's doing very well. So I'm afraid Stuart Owen has a 4 o'clock flight tomorrow morning and he's had to go. But I will finish up. So final thoughts on summary. So Somary was of the Austrian school, and he believed in the power of free markets. Free markets should set interest rates, and central bank manipulation of interest rates distorts incentives and leads to suboptimal results. In the real world, of course, central banks now control interest rates, and they can suppress long-term bond yields via QE as long as inflation remains low. What they can't do is control the exchange rate. So Somary is correct in his assertion that the sovereign will default via the value of the currency in my books. And currently GBP is showing little sign of a crisis in confidence in the country, frankly. So I don't think there's much of credit risk attached to the UK. And finally, global warming. So this week you may have seen that there's been some further modelling of the Gulf Stream. Now, the concern is that, so this is the Gulf Stream, brings water up from the Caribbean to the west coast of Britain and Ireland, and means that Britain and Ireland is much warmer than Canada, which is on the same latitude. Now, the worry is that as global warming melts the ice caps in the Arctic, you'll get flows of cold water coming down through the Labrador Sea and flowing into the North Atlantic, and they would tend to sever the flows of the Gulf Stream, cutting this circular flow off and stopping warm water from the Caribbean coming to the UK. So this has always been known as a danger, but the latest modelling suggests the danger is much higher than previously thought. So this is the chart you need to worry about. This is the amount of ocean heat being transferred north via the Gulf Stream, and the x-axis is time. And what the scientists are saying is that there's a good probability that the Gulf Stream is going to weaken a lot over the next couple of 100 years. So it could cut the amount of heat transferred to Europe by the Gulf Stream by up to 80%, which means temperatures in the UK could fall by 5 degrees or more. That's a hell of a lot. Bottom line is, if you're old like me, it's not going to affect us really very much. Another reason why Gen Z is stuffed, as well as house prices, obviously. So on to Inflation Watch. UK inflation heading in the wrong direction. God, I hope it peaks in September, but that is 2 months away. We'll get August data in a few weeks' time, and then September data mid-October. So frankly, we're not going to see a peak in inflation in the numbers until 3 months at the very earliest. Not good. US inflation also rising. Japanese inflation actually coming down a bit. Chinese inflation 0. And after all that, some good news. And I thought this was great. This is fatalities per million passengers. And this shows the effect of incremental process improvements. The aviation industry has a really good safety record because they take safety incredibly seriously. So each incident is investigated thoroughly, and people who admit to making mistakes are not punished. Lessons are learned. They're sent for retraining. So that means that accidents and incidents are not covered up. So as a result, you get this continual improvement in airline safety. When I was a child, we considered flying to be a bit risky. Now, nobody even thinks about it. The last serious accident in the UK involving an airline. I was thinking them 95, a long time ago. So, concluding comments. Well, Donald Trump is attempting to undermine Fed independence. That's good for gold and hard assets, bad for inflation, bad for bonds. UK inflation continues to rise, sadly, and the Bank of England is assuming that a slowing UK labour market will bring wage growth under control. As wage growth comes under control, so inflation will come under control. I note that the doctors have been on strike recently, and London tube strikes return next week. So the UK has historically had an inflation problem because it has, economist euphemism here, concentrated industries with pricing power, i.e. transport unions, etc. And it looks like they're flexing their muscles again. So will a cooling labour market actually feed through to slowing inflation? Previously, I've thought it was inevitable. Now, frankly, I'm less sure. Thank you all for watching. Thank you very much for Stuart Owen for chipping in. We now have a bit of an interrupted period because I'm in and out of the country, and but I will get something out when I can. Thank you all very much for continuing to watch, despite my disastrous dalliance with bonds. I hope you're all doing much better than me. Please can you press like and subscribe to the channel, and it's goodbye from me, Keith Jordan, and it's a previous goodbye from Stuart Owen. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.